I gotta tell you, some of these influencers and the way that they analyze deals on social media has been driving me nuts. You've probably seen this before, but I was just on Instagram, just like screaming at my phone, looking at how overly simplistic and honestly, dishonestly, people are analyzing deals. They're talking about how many deals they buy in real estate and how their cash flow is amazing, even in this difficult market. And then they go on to prove it to you by saying something like, check out this property. My rent is just $2,000. My mortgage payment is $1,200. And look at that, I'm cash flowing $800. Yeah, how convenient that is when you just forget half of the expenses and half of the equation that you need to actually calculate cash flow the right way. So first and foremost, please do not underwrite deals like this. It is a path to risk, to disappointment, and probably to financial loss. And the reason I was getting so frustrated when I was watching these videos a few minutes ago and came to make this YouTube video in a response to it is because one, it's just dishonest. You're pretending that you generate this cash flow when you really don't even know how to calculate cash flow in the first place. And then secondly, the thing is that it's not actually very hard to do this correct. It's so easy to just do it the right way. And so I came here on YouTube, or I sat down in my studio to make a YouTube video to just show you how you can actually calculate cash flow really easy. And I'm gonna show you in just the next 5 to 10 minutes. And I'm also just gonna show you realistically what a good level of cash flow and cash on cash return is and what you should be expecting in this type of market. Hey, what's up everyone? It's Dave Meyer. I'm a real estate investor. I'm an analyst. I'm also the author of Real Estate by the Numbers. It is a book I wrote with Jay Scott that's literally all about properly calculating real estate investing metrics. So seeing these just horrible takes on social media and people calculating all these pretty simple metrics so wrong kind of drives me insane. So that's why I'm here to show you the right way to do it. The great thing is that cash flow is quite simple to calculate in theory. All it is income minus expenses. And so in that way, these influencers are kind of getting it right because yes, you just start with your rent and you subtract your expenses. But where they've gone wrong is they're just saying mortgage is your only expense, or mortgage maybe sometimes they include repairs or they include maintenance. But there are a lot of other categories of expenses that you need to factor in. And here's basically how you should be thinking about it. And actually, I should mention, before I go into the expense buckets, which I'm going to do in a minute, I'm kind of going to skip over the rent or income part of the cash flow equation because it's sort of the easier part. For most people, when you're figuring out income, it's just rental income. You take your monthly rent, you multiply it by 12, that's your annual income. If you have a property that has other sources of income, like maybe parking fees or pet rent or a coin-operated laundry machine, whatever it is, make sure you get that all in, annualize it, and you have one half of the equation, income. When you get to the expense side of the equation, it is a little bit more complicated, but I'm just going to separate it into 3 buckets for our conversation today. The first bucket is debt service. This is basically what you're paying on your mortgage. We'll get more into it in a second. The second is operating expenses, basically things you need to maintain your property and your business. And the third is property management. That's really an operating expense, but I'm breaking it out. You'll see why in a minute because I just want to talk about property management for a minute. But these are the 3 big buckets that we have. And before we talk about the individual things, just remember that whenever you're coming up with your expenses and trying to calculate cash flow, please be really conservative with your inputs. Don't assume that everything is going to go well because honestly, it doesn't matter if you get all the expenses and all the buckets right if your inputs are completely off. So make sure that you're sort of taking the low end of what you expect is going to happen. And the reason that I recommend this, and I do this myself, is because when I run a deal and I calculate my cash flow, the number that gets spit out at the end of my analysis, I want that to be the worst case scenario, right? I want that to be if everything possibly goes wrong and I have a really bad year, what's my cash on cash return? Because for me, if I run a deal and assuming everything goes poorly and I still like the deal, then it's great, right? Then it's an obvious buy to me. And if things go wrong, I'm still going to be okay. I'm not going to be in a bad situation. Things are probably not all going to go wrong and I'll probably do better than what I calculated. To me, that's so much better than assuming everything's going to go well and then just disappointing yourself. I rather set myself up with low expectations and then exceed them in the future. Okay, so that said, let's just talk about the buckets here. So the first one I said is debt service, which is just another way of saying mortgage payment. And your mortgage payment is usually made up of two things. You might hear it called P&I, principal and interest. This is basically when you pay the bank every month. There are two components of that payment. The first is principal, which is basically paying back the bank what you owe. And then there's interest, which is just the bank's profit. Not all mortgages work that way. Some are interest only, so you'll only have the interest part of that payment. But for the majority of loans that most people get for real estate, you are paying both principal and interest. The great thing about mortgage payments is that they're generally fixed over long periods of time. Even if you have an adjustable rate mortgage, it's usually fixed for 3, 5, 7, maybe even 10 years. And so these payments are relatively predictable and you know what you're going to pay each and every month. So that makes it really easy part of your calculation. And you can go out and just talk to a lender and get a very detailed, highly accurate estimate of what you would be paying every month. So this is one of the easier expense buckets that you need when you're calculating your cash flow. Now, there are two other payments. They are fixed costs, but they are technically operating expenses that are sometimes included with a mortgage payment. Sometimes when you have your mortgage serviced by a bank, they also include your home insurance and your taxes in that payment. Technically, they are not debt service, just to be clear, they're operating expenses. And these are relatively easy to estimate as well. So for taxes, almost every county has a website where you can just look up the taxes for a property. It's publicly available, free information. Even websites like Zillow or Redfin have them usually just listed right there. So you should absolutely include that in your analysis. Insurance, you can Google it and get a rough idea. But also an insurance broker is going to be very happy to just give you a free estimate. So you might as well go online. There's tons of different companies where you can just spend literally like 3 to 5 minutes just putting in information about a property where you're analyzing it and get an insurance quote. So you should definitely do that. With these four things, your debt service, principal, interest, insurance, and taxes, you are getting a lot of your expenses. So in that way, when these influencers that I'm villainizing today are putting these videos, they are taking up a lot of the expenses, but that is not it. You have to move on to other operating expenses. These are things like repairs and maintenance, so that's keeping the property in proper working conditions. Capital expenditures, otherwise called CapEx, and these are similar to repair and maintenance, but they are either big things like repairing a roof, an HVAC system, a hot water tank, or making improvements to the property. So if you were going to add a third bedroom or to finish out a basement, that would be considered a capital expenditure. Those are absolutely big costs that you need to calculate in your analysis. We also have two things related to tenants moving in and out. There are turnover costs. So that is when a tenant moves out, usually you have some marketing fees. Maybe you have to pay a property manager to find a tenant if you're not self-managing. And a lot of times there's just small stuff that you have to fix up. Maybe there's some cleaning expenses. You need to do some drywall patches. You need to throw a little paint in a couple of rooms. Those are turnover costs. You got to calculate those as well. And then vacancy. No one wants vacancy as a real estate investor. I have, built most of my portfolio around the idea of minimizing vacancy because it can be expensive, but I still count on vacancy happening. I personally account for 8% vacancy every single year. That's about the equivalent of 1 month of vacancy a year, just to be sure. I put that money off to the side because remember, I want to be conservative and I want this to be the worst case scenario. Sure, vacancies could happen for 2 or 3 months, but I'm trying to be realistic about some of the downsides that can happen. And a vacancy could happen, even though in my career, I think if you're a good, diligent landlord, you can usually minimize your vacancies and not have a vacancy every single year. The last one is utilities. That doesn't apply to every single property, but sometimes as a landlord, you do pay utilities, and you should be careful to know what utilities that you do have to pay for. If you're wondering how to estimate these things, there are a couple of ways that I would recommend. First and foremost, just Google it. Like you could just Google average repairs, average CapEx. Like if you know in a deal that you're going to need to replace a roof, you could just Google that. Put that in your analysis. The other way I think that's really good is to talk to investors. So if you have like a duplex that's good quality in a B-class neighborhood, go find other investors in a similar neighborhood with properties in a similar condition and ask them what their repairs and maintenance are in a given month or in a given year. And if you don't know people yet, you can meet them at a local RIA, or you can go on BiggerPockets.com where we have forums. You can just go and ask people what a good reasonable estimate is there. And that's a great way to do it. There are also some data websites where they just provide rough estimates for how much different types of repair projects cost, how much utilities cost, and you should go check that out. At least get a good rule of thumb or ballpark number. That's better than just omitting these expenses altogether like some people are doing. At least get kind of close using some of these estimates. The last expense that I want to talk about is property management. Now, a lot of new investors choose not to include property management in their analysis because they're planning to live in the property, like a house hack, or they're going to self-manage, both of which are great ideas. I usually recommend to people that they do self-manage. You just learn so much about the business and you really save a lot of money. And so I recommend that to people. But I would still advise that you analyze your deals with a property management fee of 8 to 10% of your income, because you don't know what's going to happen. Like one day you might want to move out of that property and get a property manager, and you want to make sure that that deal is still going to pencil and you don't have to sell at an inopportune time. Or I think the better, more likely scenario is that most real estate investors start self-managing, and then over the course of their career, they want to spend more time doing other stuff. And so they hire a property manager. That's what I did. I self-managed for the first 8 years of my portfolio. No, actually the first 10 years. And then for the last 4 years, I've been hiring a property manager. And I don't want to sell those deals. And so if I didn't factor in property management when I was buying deals, I might have had to give up some of those deals because they wouldn't be cash flowing right now. But since I only found deals that worked with my eventual property manager, now I can hold on to them and they're performing quite well. So just as a recap, those are the 3 buckets that I encourage. Look at debt service, your operating expenses, and then property management. You can decide how you want to do that, but that's how I would do it. And just remember to be conservative in those inputs. So that's it. That's how you do it. You take your income and then you subtract off your expenses, but just don't forget or omit some of the more important expenses like repairs, maintenance, vacancy. Those things can come back and bite you in the butt. You do not want to be caught off guard thinking you have this cash flowing property and then all of a sudden you have a leak or a repair, and all of the money that you thought was quote unquote cash flow and that was your profit now gets totally sucked up. I'll just give you a quick story that last week just had a terrible week landlording. In one unit, I had 2 different leaks. One was a pipe sort of broke in a supply line to a toilet broke, and it caused like $3,500 of damage. And then I had a gas leak that cost $6,500 to repair. And that really hurt. And I learned some lessons about being more proactive about property management and inspecting those things. But the thing that I did well and that I'm happy about is that I've built up in this property, I've owned it for like 10 years, about $30,000 in reserves, because this is a 100-year-old property and I know stuff is going to break. And so I have that 30 grand sitting there. I don't consider that quote unquote cash flow. That is not. That is repair reserves. Those are cash reserves, operating reserves, because I know one day these things are going to come up. And that might seem like a trivial difference. Like, why don't I just put it in my bank account? But at least for me, I like to put aside that money for vacancy, put aside that money for CapEx, because mentally then I don't think of it as mine. Like I never counted that $30,000 as mine, Dave's. It's the business's money. And the business is going to come knocking for that money at some point. And for me, that happened last week. So this is why you have to factor in all these expenses in your analysis. You don't want to be caught off guard. You want to be prepared. So that's it for doing the analysis. And then I just wanted to call out what a good cash on cash return is, at least for me right now. And that's a totally subjective number, but I'll tell you at least how I think about it because I get this question quite a lot. Here's my general thinking. If I can find a property, a long-term property that's in good condition and it's in a good neighborhood with a 3 to 6% cash on cash return, using all of the above calculations, I think that's a pretty good deal. If you're over 6%, I think that is a killer deal in today's day and age. So 3 to 6% if it's a good neighborhood and a good quality property. If the property is in a less desirable neighborhood, that increases my risk and it reduces my upside for appreciation. And to compensate for that risk and reduced upside, I want more cash flow. And so for that, if it's in a medium neighborhood, I'd probably want it to be in the 6 to 8% range for cash on cash return. Then if it's in a really undesirable neighborhood, it's a really risky deal in some way, that it would have to be higher than 8%. Sometimes it would have to be higher than 10%. So I encourage you to think about it on that spectrum. Like the less risky the deal, the lower the cash on cash return I think of, the riskier the deal, the higher cash and cash return I expect. And if you're wondering where I came up with these numbers, I'll just give you an idea of how at least I think about it. To me, it's really about what else you would do with your money, right? So like how else would you generate cash using the money you have to invest? There are some other ways. You could put in a savings account right now, high yield savings account, not bad at 4%. Bond yields as of today, I think they're at like 3.6%. You can buy dividend stocks that can yield 1, 2, or maybe 3% cash each year. So those are all decent options. But that is why I choose 3 to 4% as my low end here, because I want to find a real estate deal that offers me the same or better cash flow than any bond, any savings account, any dividend stock could offer me, right? Because then I'm at least even with all of the other assets I could be investing in. But then on top of that, real estate makes you money in other ways. So you get appreciation, you get amortization, you could force appreciation, you get tax benefits. So to me, that's how I think about it. You make the cash flow at least even with other types of investments, and then the upside of amortization, appreciation, tax benefits justifies the time, expense, risk of buying real estate instead of just something that's truly passive like investing in a REIT, because you get sufficient upside over other investments. And remember, the way I'm analyzing this is a 3 or 4% worst case scenario. And now it's not truly the worst case scenario, but that is like a pretty bad outcome is if I get that 3 to 4% cash on cash return. So very likely I'll do better than that, and it will likely grow over time as rents grow and my debt stays fixed. So that's how I, a relatively conservative investor, thinks about buying deals in this type of market. And whatever cash on cash return you're targeting, what I was telling you about expenses is the right way to do it. Do not admit any of those buckets, any of those categories of expenses. That is going to hurt you. And I know that compared to someone on Instagram, my cash flow numbers don't look as sexy. And honestly, that is totally fine for me because I'm pretty confident that the money that I actually make, the profit I actually take home at the end of the day is going to be higher because I am running my numbers the right way and I am accounting for all of the expenses. And when I say cash flow is actually cash flow, it's not money you just hold on to until you have to make a repair or maintenance or cover some vacancy. So that's it. If you guys need help running your numbers, you can always use the BiggerPockets calculators. You can actually try them out for free and they'll do all the behind the scenes math for you. I'll put a link below. And one more thing, if you guys are ready to multiply your real estate investing or just trying to snag your first deal, I encourage you to discover why DealMachine is the top choice for both novice and seasoned investors eager to land more off-market deals. Imagine for a second seamless access to accurate owner contact information for free, powered by the same data that supports 90% of US caller ID, boosting efficiency and reducing search time. So you can forget these outdated skip tracing methods and instantly find contact info for property owners totally hassle-free. Plus, with DealMachine's new private investigator tool, you can track down even the trickiest leads, including corporate owners. Streamline your deal funding process and start your free deal trial today. We'll put the link for that below as well. Thank you all so much for watching. If you guys have any questions about deal analysis, please hit me up. I love talking about this stuff. You can find me on BiggerPockets. You can find me on Instagram where I'm at the Data Deli. Thanks again. For BiggerPockets, I'm Dave Meyer. See you next time.